Underwriting is an important aspect of the construction finance loan. In this, the objective of the underwriter is not only to assess the ability but also the intent of the developer to pay the loan. Construction finance is a cash flow based lending, and hence the assessment of the future cash flows is a very important aspect of the underwriting process. The underwriting process can be divided into two parts: assessment of the borrower and assessment of the project. In terms of the assessment of the borrower, the underwriter does a civil check and also does a background check of the developer. The civil check, for example, the civil check shows that if there are any delays in the loan repayment, the clarifications are sought to understand whether these are temporary cash flow mismatch or there is a fundamental over leveraging that is there at the developer level. In terms of the background check, the check is also done with the peer lenders as well as with the peer developers. The repayment, the track record of the repayment of the historical loans are also looked at. For example, a typical lending institution will not lend to a developer who had an earlier history of NPA with any other lending institution. It is important to also assess the overall organization structure of the developer. Typically, the developer should have their own independent sales and marketing team, construction team, project team when they are doing a project which are upwards of 500,000 or million square feet of development. Some other important factors or relevant factors is also what is the developer's skin in the game. What do you mean by the skin in the game? In a typical project, the lender would expect that if the project cost is 100 rupees, at least 30 to 40 rupees should be infused by the developer from his own sources, and the rupees 100 also includes the cost of the underlying land, because that shows his commitment to the project. And the lender's money is also well protected in instances where the developer has put more money as their equity than in instances where they don't put their equity money. As a part of the assessment of borrower, it is also important to do checks on the current account statement of the borrower using certain softwares which are available today. That helps us to understand the financial discipline of the borrower, whether there are check bounces, etc. instances, then the underwriter will get more discomforted. It is also important to do the analysis of the balance sheet of the borrower to understand what is the debt equity which they have at the group level, what is the kind of revenue that they earned in the last financial year, what is the projections of their revenue for the next 3 to 5 years, and what is the profitability that the developer expects to make from the project and overall at a group level. In a lot of instances, the lender also takes comfort on the overall surplus that the developer is going to generate from his other projects. The next step is the assessment of the project. As explained in the earlier section, the assessment of the underlying projects include the study of the micro market in terms of the location of the project, the stage of the project, the infrastructure that is developed around that. This helps the underwriter to estimate the selling price and the sales velocity of the underlying project. For example, the way to do is, if a developer is developing a project in Thane, the underwriter will try to understand the comparable sales price of the other developer, whether the location is superior or inferior, the product is superior or inferior to the other developers, and then make his own estimate of the selling price for his underlying cash flow assumption. That assumption can be different from the assumption which is shared by the developer as a part of his application and the business plan submitted by him. The next important aspect for the underwriter is to do the sensitivity on the cash flow that he prepares. The sensitivity of the cash flow can be done by doing sensitivity on the projected revenue, the projected construction expenses, and the timeline by which the project will be delivered. This helps them to understand what is the cash flow at risk or deficit that come if the selling price increases, the construction cost goes up, and there are delays. The underwriter then uses his subjective and objective judgment to see whether the promoter or the developer has the equity to pump or the shortfall that can come during the project execution. The underwriter also goes through the title and technical analysis of the project. The title analysis or the title diligence of the project will ensure and give comfort to the underwriter that there are no legal issues. We have seen projects where the underlying sales price as well as the velocity is impacted if there are historical title related issues in the project. In respect of the technical diligence of the project, the underwriter assesses the entire cost in respect of the benchmark of what is the prevailing construction cost for the project of this size. For example, if a project is a standalone building, the construction cost will be very different to a project where it's a larger layout with the underlying infrastructure development and multiple buildings. There are technical agencies who are expert in assessing the technical cost and also commenting on the approval risk of an underlying project, and the underwriter relies on such vendors to assess the risk and mitigants for the technical and the title related issues of the underlying project. The underwriter also does the financial closure analysis of the project. This is very important from a perspective of lender. The financial closure analysis means the assessment in respect of what is the quantum of sales that needs to be done further to ensure that the project cost is covered. Typically, for example, when a developer comes for his construction finance project, the requirement varies from 30 to 50% of the pending cost, and the 50% of the balance cost needs to be met through future sales. And the financial closure analysis, the idea of the financial closure analysis is to ensure that the project completion is achieved within the stipulated time of the entire loan. The typical cash flow cover that the lender looks at can vary from 1.5 to 2 times. To elaborate this further, the cash flow cover is calculated as follows. The inflows from the future sales and the receivables is projected, and you deduct the future construction cost to arrive at the surplus of the project. So for example, if the developer is estimating 100 rupees collection from the existing sold receivables and future sale, and he is estimating that he will spend 50 rupees on the construction, the surplus from the project is estimated to be 50 rupees. Now, if we assume that a 50 rupee loan is taken to fund the entire 100% pending cost, then the way to calculate the cash cover will be as follows. 100 rupee collection plus 50 rupees of construction finance gives a total inflow to the developer of 150 rupees, against which there is a cost of 50 rupee which he will incur in the project, which means that there is a surplus of 100 rupee to service the loan principal of 50 plus the interest. Assuming the interest cost is 25 rupees, the balance, which is 75 rupees, is available to serve the 50 crore principal loan that is given, and the cover is basically rupees 75 divided by 50 as the cover, which is 1.5 times. So this is how a typical cash flow cover is calculated for a construction finance. In this section, we will discuss about the pre-disbursement and post-disbursement compliances for a typical developer finance. The pre-disbursement requirement includes the execution of the loan agreement, which captures all the major terms of the loan, including the interest rate, the repayment schedule, etc. The KYC, the completion of the KYC of the borrower company, and all the shareholders of the borrower. The CP also includes the execution of the underlying security agreements, opening of the escrow account, and the execution of the escrow agreement. The acceptance of the sanction letter and the request letter from the borrower is a prerequisite for any CF disbursement. In terms of the post-disbursement compliances, the important aspects that the lender typically looks at is the adherence to the business plan that has been submitted by the developer. The developer also shares the MIS relating to the project on a periodic basis. It could be on a monthly or a quarterly basis, depending on the comfort of the lender. The condition subsequents also include adherence of the construction and the sales milestones that has been agreed between the developer and the lender. The post disbursement also includes the perfection of the security and filings of the forms under the Companies Act. There are certain general compliances also which the lender has to take care of. Typically, the construction finance loan cannot exceed for a single borrower up to 15% of the Tier 1 capital, and on a group basis 25% of the Tier 1 capital. Typically, banks cannot disburse construction finance loan for the purpose of acquisition of land. It is prohibited under the RBI guideline. CF loan, once disbursed, cannot be changed except under the DCCO guidelines prescribed by the RBI. What is DCCO? DCCO is the date of commercial commencement of the project, which is nothing but the date by which the developer is expecting to give possession of the underlying project to the home buyers. Typically, we have seen in real estate, there are delays in project on account of approvals, on account of financials, wherein the project execution gets delayed. Under the current framework of the DCCO, the tenure of such loans where there are delays in the project and the reasons are beyond the control of the promoter can be extended as per this DCCO guidelines prescribed by the RBI.